Last week, we shared with you some highlights of the U.S. apartment market performance from 2Q 2013, and I could summarize in brief. They were terrific. And today on Apartment Market Dynamics from MPF Research, we'll be digging into those numbers a little bit more. And in particular, we'll be talking about why second quarter was such a critical period to watch and why those results were so encouraging. And we're also going to talk about some key things to watch for the rest of the year. And that's an ambitious agenda. And so Greg Willett is here with me to help get through it. Greg, not all quarters are created equally, are they?
They're not. I mean, one reason that second quarter results were important simply because it was second quarter. There is lots of seasonality in apartment demand. Let's go to fourth quarter. Almost always some net move-outs there. That's happened in 18 of the past 20 years. When you get to first quarter, if you're lucky, you get enough demand to make up for whoever you just lost. So that really means that the bulk of all the demand that registers during the course of the year comes in second and third quarter. And then also I'll point out, whatever rents you get in second and third quarter, that's what the bulk of your residents are going to be paying for throughout the year. So again, just the fact that it's 2Q alone is a big deal.
And looking beyond the normal seasonality, 2Q of this year was particularly important because operators and owners knew they'd be dealing with more churn in this particular period, particularly the top end of the market. First of all, we had a pretty sizable block of new product completing in Q2 2013, have an even bigger block set to complete in Q3. And so even those units are starting to pre-lease now. And that demand for those units is affecting some existing communities simply because a lot of the new demand that's being created, not everyone could afford a brand new apartment. So we are seeing some churn out of some top-end communities that were built in the past decade and into some of this brand new product. And at the same time, some of those top-end communities are also starting to see a loss of some renters to home purchase. Now that we're seeing some big gains in home sales, and not just investor sales, but now actual home buyers, or maybe we call them home buyers / home livers, people who are actually buying a home to live in it. And so all of these things made Q2's performance particularly important.
And what you're really talking about is we had some resident churn, and particularly as you look at if folks chose to go to a brand new apartment community or they bought a single family home, those are really lifestyle choices. So if you're operating at the top end of the existing market, there's not much you can do to prevent those folks from making that choice. So the question becomes, are you going to get enough new renters coming in to replace whoever you're going to lose? And when you look at the okay but not great job production numbers that we're having, as we went into second quarter, it was really not clear whether we were going to have those replacement renters or not. But we did in a really, really big way. So that means the top part of the existing marketplace remained pretty full, and folks got more aggressive on the pricing for those units.
And during the last half of 2012 and the first few months of 2013, Greg, we talked a lot about operators playing defense. They were cautious about pushing rents just because they knew what was going to be happening in 2Q with this churn issue coming up. And so the focus was really on getting full when this period hit. So Greg, were you surprised that operators were so aggressive in Q2 with pricing?
Well, again, there weren't necessarily the signs there that they were going to go that route, but I'm going to give technology some of the credit for that, and that a lot, particularly at the top end of that marketplace, within the existing product, you have some sophisticated operators who are using technologies that you can look at the hard data in real time in terms of how many renter prospects are showing up, coming through that front door, and I think that helped give them the confidence to actually go ahead and make that move when, if you had talked to them previous to hitting that demand upturn, they didn't really seem ready to actually do that.
Now let's talk a little about what lies ahead in the immediate future. Something that jumps out as we look at some of the new construction numbers is that this year's scheduled completions are really stacked toward the second half of the year. Here are some numbers for you. About 60,000 units completed in the nation's 100 largest markets in the first half of the year. But in the second half of the year, there are 90,000 apartments that are scheduled to complete. And for Q3, what we're shooting for is just to sustain the revenue momentum that we saw in Q2. We don't anticipate another big quarter-over-quarter pop of increased momentum like we just saw. And so we're looking for occupancy to pretty much hold steady around that 95.3% mark where we are now, and for rents to climb about 1% quarter-over-quarter. That would basically match up with what we saw last year in Q3, but it would be below the 1.6% increase we saw in Q2 of this year.
Let me take the numbers a little bit further and talk about, as we get into the last few months of the year into fourth quarter, what we'll probably see there is some normal seasonal slowdown, and particularly given that we're going to have a lot of new product coming on at that time. Certainly, occupancy is going to backtrack a little bit. Looking at the numbers right now, we're expecting about 50 basis points for a quarterly loss at the end of the year. But again, that's going to leave us in pretty good shape. And when you look at pricing, what we're really going to be shooting for in fourth quarter is basically zero change. Keep the rents about where they were in third quarter. Anything that's actually just not negative, we should probably view as a victory when we're in that leasing time period.
So to summarize then, the U.S. apartment market hit a point of vulnerability in Q2. The market passed with flying colors. The immediate outlook is that we sustain the momentum that we gained in 2Q through third quarter, and then register only a mild backslide in the fourth quarter of the year. It's not a bad outlook.
It's not a bad outlook.
So with that, let's wrap it up. For Apartment Market Dynamics, I'm Jay Parsons. He's Greg Willett. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.